Welcome, everyone. In an email exchange I had earlier with Bob Neff, he said that he thought financial engineering and structured products were, whatever the downsides to them, were here to stay and part of the financial landscape going forward. If anyone wants to argue that point, we can argue it later. But I think it makes this panel not only very timely, but also a panel that's going to be of enduring interest. So instead of introducing each of our panel members, I'm going to let each panel member introduce himself and briefly outline his thinking. And then I'll ask a few questions before I open it up to questions from the audience. So why don't we start from the left?
Okay. I'm Bob Neff. I'm Chief Risk Officer at Selfish Capital, and prior to that I was at Bear Stearns for 13 years, heading up the Market Risk Department. Yeah, as Bethany said, I really do think that structured products are here to stay. Some of the noise in the press talking about them going away and the death of this product or that reminds me a lot about the BT, PD years when everybody thought that was going to be the death of derivatives, but derivatives have only continued to get stronger and stronger since then. Or in 1998 when everyone thought long-term capital would be the death of VAR, and VAR didn't seem to die. So I think these issues, as Bethany said, these issues are going to continue, and the valuation challenges have to continue to be addressed and grappled with. The other bullet point I would make is there's a lot of focus on level 3 assets these days. It seems like one of the buzzwords, subprime and level 3, seem to be a couple of the biggest buzzwords. And I really believe that the problem hasn't really been level 3. It's really been a level 2 problem, and there's a real misconception about that. And we can certainly get into that deeper later. Other opinions I have, in terms of valuation challenges, I frankly find that a lot of the focus here is on the asset side of the challenge. But I find this new idea of marking to market the liability side for credit spreads to be about the most ridiculous issue and the largest, kind of craziest valuation issue of the things that are out there. I read that someone tallied up $6.8 billion of profits were booked across 6 different firms in the first quarter of 2008 from widening of their debt spreads. So that seems crazy to me, but we'll let the accounting people touch into that in more depth. There's a lot of talk about mark-to-market accounting. I think the reality is that most of when you read it, it's really focused on fair value accounting, and I happen to think there's a lot of wiggle room between a pure mark-to-market distressed level versus a fair value valuation. I'm sure we'll get into that as well. So in terms of some of the things that I think about in terms of suggestions or where we may go from here, I think transparency is an important issue. I think one of the reasons there's so much focus on valuation is that there's such a lack of transparency. I think the two issues kind of go hand in hand. And it's a double whammy when you're not sure what you have and you're not sure what it's worth. So I think that's something worth exploring further. The idea of using VAR for regulatory capital within a trading book framework for some of the level 3 assets, I think is something that shouldn't be allowed and needs to change, as well as I think there probably needs to be some other capital add-ons. And the other issue I think that's worth exploring is the whole concept of origination P&L. The financial engineer, all of you guys, it's sort of in your DNA, the concept of net present value. And that concept certainly has gotten extended to day one origination profits. And those were always some of our more challenging valuation issues in terms of how much P&L should be taken day one. And so just touching on that area, I think that's something else that bears exploring further.
Thank you. Rudder Associates is a boutique risk advisory firm, but for the last 7 months or so, almost the only thing people want to talk to my colleagues and me about is valuing structured securities that have a collateral pool that contains U.S. subprime mortgages. Leslie Rawl here in the front row, I actually blame it on you, Leslie. I remember a meeting in your office where you said, well, Charles, you guys understand how to value tranches of CDOs of corporates. Don't you think you ought to be able to value CDOs of asset-backed securities? And the right answer was no. But it's taken us, since we gave the wrong answer. So the last 7 months or so has been really focused on just tranches of RMBS, tranches of CDS of ABS, where the ABS are primarily RMBS, or tranches of CDO squared. And so you can see that my focus over the last 7 months has really gotten there. I really have tunnel vision. And so when David and I first talked about speaking at this, I really expected the topic would be valuing assets linked to subprime debt. Well, in the time since our original conversation, it's broadened into valuation and stress, but I'll warn you ahead of time that everything that I talk about will have that strong kind of the experience of the last 7 months. And so with that kind of, my comments to begin are really very narrow. When I think about what we've been looking at over the last 7 months, and I think about marking to market the assets that we've been looking at, marking to market is just not appropriate. Then you have to say, well, if that's not appropriate, how about marking to model? And marking to model, I would say, can be appropriate. And the things we've learned over the last 7 months is to change that can be into would be requires an enormous attention on, are there enough marks out there of things that are components of or similar to be able to get to change that could be appropriate to would be appropriate.
Well, given that I'm representative from PricewaterhouseCoopers and Bob, as you said, sort of the accounting guy, I guess, I think that I want to sort of focus the discussion a little bit on sort of what is the target, what are we really trying to measure here. My firm, as an auditor to many, many companies, as an advisor to many, many companies, who all carry assets and liabilities at fair value, we've been spending an awful lot of time over the last 9 months, 10 months, thinking exactly about these issues and challenging our clients to really think about what is fair value? How do you really think about it? Over that period of time, I kept saying to myself, well, each month it's bad, but gee, it really can't get much worse. And each month I've been proven wrong. There's just much less price transparency out there. You know, there are no transactions. Data that's out there, you have to question. You know, you can't rely on anything. You have to really sit back and say, okay, well, what does this mean to fair value? How do I really think about it? How do I actually come up with something that we all can agree is some way, shape, or form fair value? Now, fortunately, the FASB, and being a representative of the accounting firm that I am here, you know, the FASB made it easy on us. The FASB came out with FAS 157 and sort of said, okay, fair value is really easy. It's basically a price that a willing buyer and willing seller transact, but they use some specific words. You know, so fair value is the price at which would be received for an asset or paid for to transfer a liability in a current transactions between market participants in the reference market for that asset or liability. Embedded in that are a bunch of really neat concepts and really hard concepts to execute on, but really important because those are the terms that are going to be used by, at least in terms of financial reporting, to describe fair value. One of the key things, and since we're talking about sort of a valuation in distress, is that definition actually is trying to avoid distress. So there's a notion of a current transaction, but a current transaction isn't a forced transaction. It's not a liquidation value. So it's something that, again, FASB thought about a little bit, and it's amazing I'm defending the FASB as much as I am, but I guess I feel I have to. But more importantly, you know, it's part of what they were thinking about. They really they thought about it. Now, unfortunately, they didn't give anyone any rules. There's no way to actually know what a for sale is under these rules. But we have these set rules. And unfortunately, the FASB also didn't give an awful lot more guidance beyond that. They talked a little bit about credit valuation, which Bob mentioned, talked about things related to restricted securities, but beyond that, this is all a bunch of principles we all have to sort of aim for, and we all have to sort of decide what really is fair value. Now, I'm certain we're going to debate the benefits and drawbacks of mark-to-market accounting over the next hour or so. But the thing that we've been most focused in on over the last 9 or 10 months is also, how does one actually develop fair value? What are the data choices you go through? How, are your models actually thinking about the world the way it is now? What's really the right time horizon? How do you think about that current transaction? Is it a day? Is it a week? Is it a month? How do you think about all of those things in trying to define fair value and determine it? But in addition to this definitional issue of how you think about fair value, we also thought a lot, we've also been thinking about, on our part and also with our clients, an awful lot about transparency. And I agree with Bob. Transparency is a big issue in this space. And it's not only how people determine fair value, but also what are the shortcomings in their measures. Are people getting enough information about the sensitivities to the assumptions being made? Or is it all just falling into level 3, as Bob said, and that's all you need to know? Thinking that you probably need to know more. A clear example in my mind of where this all falls apart is that companies take huge, billions and billions of dollars worth of write-offs. And even as recently as today, there are companies who are reporting those billions and billions of dollars worth of write-offs. And then in the next sentence says, oh, but by the way, because of our credit valuation adjustment for our own credit risk, we're also going to record a gain of billions and billions of dollars. So it's transparency, but it's also making the information understandable. And I think that that's very important. So again, the things that I want to talk about and we'll be talking about will include sort of the definition of how you think about fair value, but also how you make it transparent, how you make these values understandable to the users of this data.
So I'm going to start by asking each of our panelists a question, and to the extent the other two have things you want to jump in and add to those comments, please go ahead and do so. And Bob, I thought I'd start with you, and you mentioned level 3 assets, and I'd love to dig into that a little bit more. We in the press are fascinated with level 3. It provides a nice little bucket that's very understandable to us non-financial types. And actually, it's funny because I don't think it's just the press. Executive at an investment bank said to me the other day that investors are also far too interested in level 3 assets. And I'd love to hear more about why you think the real issue is level 2.
Sure. First of all, a lot of the mark-to-market losses that have occurred have been dominated really by the top parts of the capital structure, AAA and AA securities, because if you step back and think about how these deals structure, a lot of deals, 90+% of the capital structure are AAAs. So that's where the notional values are, that's where the size is, and that's where there has been a propensity to hold those securities because they're quote-unquote less risky. And so that's where the real numbers are in terms of losses. Within an institution as well, there's always a propensity for the level 3 funkiest stuff for the managements to want to be conservative. They knew this stuff was pretty funky. You don't want to pay people too soon on it. You don't want to assume it's worth this or that. So you tend to be conservative in the valuation. So level 3 can be a place where there are actually some hidden gains in some firms. And also they tend to be smaller sizes. So it's really easy to jump on level 3 as a concept, but I think the numbers and the real challenges that we're talking about are centered on level 2 more than level 3.
Is there a question? Is there one question that investors should be asking managements of financial firms about their level 2 assets?
Well, it kind of ties in with the transparency and disclosure. They're just there has been progress in terms of the 157 requirements to elaborate, but there isn't a ton. And in general, I think this whole event, this sort of subprime, because subprime has been misused about as more than level 3, because a lot of it, in my opinion, is just a major technical imbalance of so much of the AAA securities and AA securities found their ways into money market funds, and a lot of them, the vast majority, will be money good, but there just isn't a new demand function created yet for those securities. So if you ask the questions and you focus on the losses, you're getting some transparency, but there could be more. So you need focus on 3 and 2.
Are you suggesting that CDOs and CDO squares are true?
I think some of the AAAs, I think, were largely level 2.
I've seen them.
Yeah, I mean,
Part of the problem.
well, I was going to say, one of the issues with this, but I agree with where you're going, Leslie, is that I think the issue is that level 3 is really highlighting that there is just more uncertainty around this. And you're right, Bob. I think that there's an implication that level 2 is saying that, I have a pretty good idea how to measure this, and if you can't measure that, it turns out to be more problematic. But I think that what we're saying is that more and more of the structures that are causing the pain that is happening on Wall Street and more broadly is in the area of items that were level 2 and are migrating to level 3 right now. So I guess getting to the comment from the investment bank, president of the investment bank is, I think that it's also the trending. I think that that's really what's causing people concern. It is that, there's more level 3 out there than I thought. Now, it makes sense that there's more level 3 because there's less price transparency, but there's more of it, and it keeps getting bigger. So that's the problem.
And if the rating agencies did their jobs right, a lot of the level 2s would have stayed level 2s. When you misunderwrite them, they turn out to be level 3.
And Charles, I'd love to spend a little more time thinking about mark-to-market accounting, and more specifically, if we move away from mark-to-market, what's the alternative? I think a lot of people would argue that mark-to-model can pretty easily blend into mark-to-MIP. Mm-hmm. And I think one of the poster childs for anti-mark-to-market has been AIG, who argued at first that they would have no losses on any of these securities, and have ended up finally having to admit that perhaps the market price had some validity to it, although I'm not sure that's precisely how they put it. But anyway, over to you.
But kind of keep going on that. It seems like I'm also hearing that they've been down south a little bit talking to people about did I understand that correctly? That there's been some...
I think so.
So yeah, I mean, here's, again, everything that I think about lately is that those blinders that I've got on is thinking about these securities where a substantial part of the pool that backs them is made up of U.S. subprime. And here, if you look at the ones we've been looking at, they were securities that were, when issued, rated AAA. They're very high up in the capital structure, but they've got, many of them have substantial amounts of subprime mortgages that were originated in 2006 and 2007. And I'm positive those will not be money good securities. That even though they were rated AAA, there's already been enough delinquency in those fairly fresh mortgages that here then though the question that I'm going to come to a little bit later is you talked about the guidance that FASB gave us. I've been more troubled by the guidance they didn't give us.
Yes,
but kind of going back to when we look at for these kinds of securities, that mark to market has to be where somebody's going to make a bid on these. And the only bids we've seen on these have been in forced sales, have been in distressed sales, have been where somebody tacked a sign to all the telephone poles in town saying, we're having a sale on Thursday, and and it's it's a sealed bid, all or nothing, and the prices that you get are the prices you would expect. And so I don't see how, as long as the firm has the financial resources to continue to hold that portfolio, and that's a big if. I mean, I've got to have the capital to support it. But as long as I've got capital, there's no reason that I can see as an investor that I want them to write it down to that for sale level. So it kind of says then, if that's what you're going to do, if you're going to mark to model rather than marking to net, then I like that. If you're going to mark to model, it's got to be calibrated to something. It's got to have a hook. And so it's got to have a hook back into prices that are truly observable. And there you ought to stop me and say, well, Charles, there are no traded prices that are observable. And so it really gets to, you mentioned about data was sort of one of the keys that you mentioned, is I would argue that in that sense it is getting a little better, is now that there are some indicative prices. Tranches of CDO squared? Positively not. CDOs? No. But indicative prices for more of the elemental blocks that are going in this. And so if I can build some kind of valuation tool that hooks into as many of the, and here I'm struggling for a word, reliable, believable, non-laughable, whichever word you want to.
I like non-laughable.
Whichever word you want to put there for the indicative prices, because there's a tradition of what we do to indicative prices to validate that they're real. So, I mean, I believe that like almost everything, one of the big mistakes, we were talking before we got started, one of the big mistakes was to let children alone with matches. That people who didn't know much about mortgages decided we were going to put mortgages in structures, and we really weren't used to what mortgage people do. They're the most detail-oriented people you're ever going to, telling them a zip code is just not sufficient for their needs, that they want to know the address of the house that's in the portfolio. That kind of the understanding. So it says that for us to really be able to mark to model, that we actually have to get to that kind of level of detail. Now, the one piece that I want to close this little paragraph on, though, is that if you think about some of the, let me give you some kind of check numbers that in one that we did recently, we looked at a portfolio of tranches, senior and super senior tranches of CDOs of ABS, and after grinding with all of this data issue that I just mentioned, we came out and said, well, for us, it looks like the portfolio is probably worth about 40 cents on the dollar. They had tacked up a sign on the telephone poles that said we're having a sale. Well, the bids that came in are what you would predict, nowhere near 40 cents on the dollar, nearer to a dime on the dollar than 40 cents on the dollar, which is what, if I see that kind of sign, I see that we're having a rummage sale, that's the rummage sale price that I'm going to, But now the question is that price, the way that we look at it, that price reflects the huge risk premium that's in the market right now. And it reflects the illiquidity that's in the market. Not the illiquidity all the way down to the forced sale, but the illiquidity. So the place where FASB, while I smile and say where FASB didn't tell us, it didn't tell us what to do with those, because if I keep those in, the price is about 40. I argue that I wouldn't say that they're going to be good, but they're not worth it. When we finally get out of this, they're not going to be worth 40. They're probably going to be something closer to 70 than 40. But FASB didn't tell me whether I keep the risk premiums in and keep the liquidity price. See what I'm saying? So there's the place where we're sort of still flailing around.
Do you agree with that, Bob, given your comments about the structural imbalance caused by money market funds?
Yeah, what I would add is one thing that can help is you start talking to the street and you ask for some offerings, and you can start to get a sense where you could readily buy paper, and I think that can be a useful data point.
And I can't agree more. I mean, it's a constant kind of cycling, putting what you think is the right mark to model price, and then it's got to be checked constantly. It's got to be constantly challenged by if somebody's willing to tell you, if you're really lucky for somebody to give you a bid on the paper, but if they aren't, at least to tell you what their bid is. So yeah.
Yeah, I mean, I think I agree that the target is a very hard thing to describe even. It's like, okay, fair value sounds very nice and it sounds very simple. And every time you then try to peel it back and say, well, how do I actually get to that fair value? And again, it's definitional as much as anything else. But I think you're hitting a lot of what is the only solution there is, which is process. Fair value is now turning into a process. You need to think about how do I put something in place that is, that I can have consistent outcome. I can have systematic. It's financially sound. It has some bearing on this market data that you can find it. Those are the qualities that I think you end up having to use in an environment like this because there's nothing else. There aren't those transactions, so you have to look for those properties. If you find those properties, you're probably not that far off. At least you have what I call a defendable mark. It may not be right. It's clearly not going to be a clearing price, but at least it's defendable.
Then, Doug, would you also argue that that process should be disclosed to investors? Because I think one problem with any move away from mark to market is that one of the big problems in the market today is uncertainty. Uncertainty about how firms are valuing things and uncertainty about whether you can trust firms' process. And so the more leeway you give, I think the more perhaps you exacerbate that uncertainty.
Yeah, I absolutely agree. I think that one of the things that goes with processes is you need to let people know what those processes are. And I think that it's not only just giving people an idea of the process, but it's also giving them an idea of, well, if I'm wrong, how much does it matter? Now, that sounds really easy for a simple monoline business. It's a very hard thing for a diversified financial institution to do in a credible, meaningful way. So I make
forest.
yeah, exactly. Well, and you look at some of the people who tried to put that disclosure in, and I find it, and probably closer to it than many others, I find it almost disinformational. It's like overwhelmingly complicated. But with that being said, I don't know any other way to try to deal with it.
I mean, that's, although for us, the people who are going to write the checks are going to be the chief financial officer or the chief risk officer to us. But really, our primary audience is you and their regulators, because we've got to find a way to explain it where the logic shows through. It's sort of, last week there was one of the IFE sessions that I really enjoyed on what's going to be the next generation in valuation models. But really models designed for the people who are trading at the desk that need to know the recipes for building the hedge. I loved it, but I'm not going to bring you one of those models because they're just too complex to try to explain. Probably the best line I've heard during this whole process was one of the CEOs that we've worked for. I'm used to now people saying, if you can't explain it, we're not doing it. But he said, if you can't explain it in 30 minutes or less, we're not doing it.
Hey, Doug, question. How are the challenges now in terms of that process? You must have a wider breadth of one firm has this level of conservatism, they like this process, then you're auditing someone else and they have a process as well, but the two answers could diverge fairly materially. You and your brethren, how are you getting that convergence?
You're absolutely right. It's one of the real challenges in this market. Reasonable people can use very different processes, different tools, different data, and could come up with that defendable mark. So you're right. I mean, the things that we need to look at, and quite frankly, management before we get there, senior management needs to be able to assess is how do I have a reasonable process? Is it reasoned? Have I benchmarked it? Why do I believe my outcome is reasonable? Those are the types of things that I think we all are looking for, whether it's going to be senior management, an oversight committee within the organization, an auditor, a regulator. That's where people are going to be looking for. And does it hang together? Not with 20/20 hindsight, but quite frankly, does it hang together when they come in 3 days later?
We've got a question from the audience. I'm going to have Leslie
One of
jump
the
in.
things the Bank of England did quite a number of years ago on some derivatives is they actually put out a sample portfolio and asked everyone to price it so that there could be some transparency and disclosure as to what the range of prices were. And more importantly, also, so that management of these individual firms, some of them want to be conservative and some of them want to be aggressive, but none of them really know where they are on that spectrum. Do you think that type of approach would have any benefit in this environment for second quarter?
Did everyone in the audience hear the question? No. Okay. She was asking about a question about the Bank of England having put out a portfolio of derivatives and asking various firms for their valuation of it in order to explore the range that firms were coming up with. And she asked if that sort of approach would have any value in today's market. Is that a fair summary?
I mean, I think anything that adds, any incremental price discovery is a plus in this market. So I can't imagine that's a bad thing. The issue is clearly the construction. I mean, unlike the Bank of England's problem, which was a fairly narrow problem at the end of the day, it's the breadth of the problem. It's the fact that more and more asset classes are apparently challenged. How do I really run this thing in a meaningful way? But as a general matter, I think anything that creates price transparency is a good thing.
It's a question all the way in the back of the room. We'll start back there.
Let's assume for the moment everyone figures out the right way to price assets, models assets. We've all learned our lessons. The problem is the velocity of the price movement. It's driven by things that are not logical, things that are not quantifiable, things that are not predeterminable, and they randomly move quickly and sometimes move in such a way that one person's panic because they're over-levered has a cascading effect. And so I caution people when they start to blame the valuation methodologies, I caution them not to think that that's the real cause. That is a component. The other real cause, as it was in long-term capital and many other instances, is the irrational flight to quality or flight to dump a piece of paper or a flight to do whatever that really we as financial engineers still can't come to great grapple with. Comment? Question?
Well, what I think I'm hearing you say, and what I'm hearing the panel say, and please correct me if I'm wrong, is that no one really knows what anything is worth, and that what things are worth changes so quickly. Even if you do get a handle on it, it may be something different tomorrow. And what does that mean for financial institutions and for all of you in this room going forward?
It's symptomatic of just a demand function that's been destroyed, and there isn't a new demand function rebuilt yet in a stabilized way. So I don't think LIBOR plus 25 is going to be the long-term demand level for a lot of these assets. Now, is it going to be LIBOR plus 500? I don't think. I think it's going to be tighter than that. But so much havoc has been wreaked in such a short time that demand function is just slowly being rebuilt and finding its new level, and that's what's causing this volatility. And from the perspective of a hedge fund, if you're playing with other people's money and you got to sell, you're selling. So whether it's logical or not.
Question right there.
Yeah. Given that the only observable prices are distressed prices, fire sale prices, it seems like the entire market is fire sale prices, and if in the absence of anything other than fire sale prices, why is that not the market that you would mark to?
I mean, you're exactly right that if you look for where are the bids, there, to the best of my knowledge in this paper we've been looking at, are fire sale bids. But there are, why I was saying that data is becoming available is now there are indicative prices that are panel indicatives in the way that you're used to seeing them for other things that have been put through the same kind of cleaning processes. And so what did I give you the choice of the different set of adjectives that we could use? Reliable.
We decided on not laughable.
You see what that if you go out and say I've got to look at prices where there was actually a bid, where somebody had a check behind the bid, I believe you're going to see only fire sale. But where we come is convincing ourselves that as long as indicatives have the properties that we've become used to in other things, what we're doing is looking for somebody to tell us something about the mid of a doing business flow.
I don't disagree that's makes a lot of sense. Again, the one thing that I see management, regulators, and a lot of other people looking for is, again, that defendable price, and that defendable price may turn out to be the only defense you have is that seemingly unduly low price because it's a fire sale or whatever, but it's a real trade. Not to, and we see that in discussions with regulators frequently. They're saying, well, isn't that a trade? But we think it's distressed. We think it's, and then they say, show us how did you know that it was? How do you know that it isn't just that collection of multiple hedge funds that are all blowing up at the same time? And we really have a challenge doing that.
But I think it comes back to what you were talking about, and Leslie offered is that what we're doing is we're beginning to now build up a distribution of prices. And the thing that we're looking for is we don't know what the truth is, and it'll be a long time till we know what the truth is. But right now we're looking for internal consistency. It's this challenging that you were saying is that kind of everything needs to be, do the points that show up, are they consistent with the distribution you're proposing, or do they require you to go back and rebuild? So yeah.
Questions?
To me, this seems like it goes to the question of what is transparency and what is the price for.
Yes.
And if that's the way the question is, then I don't see why there has to be a single price. That why can't you say, look, this is the model price I use in my valuation, but this is my liquidation price. And that gives you more information, and people will say, oh, think of the confidence we'll lose if we show the liquidation price. I think of the confidence you'll gain if you show the liquidation price, because then people will see that, yes, I have this view and that view, and that there's some substance behind it. So I think that transparency should encourage people to give the liquidation price, not hide it in the market price.
So in case people didn't hear, the question was about using the model price and then also showing a liquidation price on the notion of transparency, so that investors can see exactly what people are doing. And I guess I'd ask, why don't people do that? Why isn't that done today?
We actually try to push people to show three. That in addition to the two you offered, I'd like one more. You're interested in seeing the liquidation value. You're looking at what would be the implied market value from the quotes you can get that have liquidity premiums and risk premiums in them, and then try to pry those back out and show what would be the once everything gets great again in price.
Sort of your 10, 40, and 70.
Yes, exactly.
I thought that was a good example.
Yeah, exactly. And yeah.
Excuse me.
You've got another question.
We seem to be tied to the fact that we believe there's a model price. We believe that there's a unique market price, or for that matter, a unique fair price. even if we split them between fire sale and non-fire sale. But nevertheless, let's say we're a trader. We happen to have some security, whatever it might be. And this security, we're going to have a number of clients that we could place this with. For some clients, because of their utility or their need, the price will be at some level. With others, it'll be at another level. Some of this may be dependent on how much. But nevertheless, there doesn't even seem to be a distinction between, in a cash market, between 5 bonds and 1,000 bonds.
The same thing exists today with respect to Google stock, but we could get so many different opinions about what that stock should be worth if we all sat down and did a financial analysis and what we would pay for a share of that company. The difference is that there is a depth of the demand function, and when buyer and seller are meeting, that it is giving a transparency. And the problem here is, I don't think it's quite what you're talking about. It's more a problem is that supply-demand function is so broken that those transactions that are crossing aren't representing much in the way of views of the holders of the vast majority of those securities on the demand and supply side.
We're assuming that there's one mode. It may be multiple modal. And if it was, that's what I was suggesting. That, still, even if you're saying it's a demand function that's broken, even if it weren't broken, if it's multimodal, which one do you pick? Or must you pick one?
Right. Well,
we seem to be under the pressure now in the industry to pick one, and that might be creating a problem.
Yeah, again, not keeping everything in terms of your books and records or even your risk information. You have to have a base case. You have to pick a number. But yeah, I think that you're right. I think that, again, more information about how uncertain one is but with respect to their value is probably good disclosure. It's the type of thing which I think readers would be very interested in.
We've got a question all the way in the back on the left, right there.
Let's assume we have a simple world where we have 3 prices or 3 values. We've got the cost basis, which is the most objective price, if you will, although it's worthless, it's not very meaningful. We then have mark-to-market, which might be imprecise, but it's fairly objective. And then third is you have mark-to-model. Now, mark-to-model, we know from the past that people have kind of used the model to manage their earnings and to get to the number they want it to be. Wouldn't investors prefer to have, in terms of the trade-off, would they not prefer to have some sort of objectivity rather than preciseness? Maybe they'll forego some of the preciseness of market in order to get that objectivity, rather than having that earnings management that comes with the supposedly more precise number if you go when you mark the model.
Doug?
Well, one of the goals of all of this fair value, all these fair value pronouncements is to try to get to some level of consistency. So I think you're hitting one of the real challenges for everyone is that, as you go further into level 2 and 3, you clearly have less consistency. And you're very much beholden on the assumptions and the techniques that people are using, the data you're using. And that's actually, to a degree, what this disclosure is trying to deal with, is trying to say, as you go further to the right, you as a reader should be less confident in that estimate. The issue, though, is that you don't have bounds or bands on how uncomfortable you should be. But at least that's the starting point. That is the thinking. The standard is trying to force you to use as much objective and market-based data as possible, but you're still trying to get to a fair value. And that tension is really the biggest tension out there. I see that all the time where companies are trying to use simpler methods, which are more defendable in one sense, but may not be getting to fair value. And we have those debates constantly.
But when Charles talks about using 3 values, which is the value, let's say, that should go into the financial statements? In other words, you can just discuss the three values, but which is the one that should be used for the financial statement. So when investors compare different funds or different firms, which is the one that they're using?
The right one. So simple.
Yeah.
Simple. Yeah, I mean, the answer is that you're supposed to be using a fair value, and that's unfortunately the hardest to get to, which is really, again, a price which someone would transact at. And that's the question. I mean, that we can go around and around.
In terms of numbers, I personally would cuff it in the $30 to $40 price range in the example that Charles gave. So certainly, if you're arguing for 10, I personally am not there. And I guess some of that comes from a couple of things. One, thinking about this issue in a larger perspective. I began my career in the life insurance industry in the early 80s. The entire industry was mark-to-market bankrupt. You had 14 to 20% interest rates. You had a company sitting with bonds with 4 to 5% coupons on them, and you had every insurance agent in the world saying, take out a policy loan at 8%, put it in a money market at 14. The industry is selling GICs to get money in, but it was mark-to-market bankrupt, the entire life industry in the U.S. So going from an accrual, that type of situation, or a Japanese kind of ignoring the valuation problems, to getting in the realm of is it 10, 20, 30, 40, to me is a big difference. And so that's one perspective. The other is I really believe, as I said before, the word subprime is really misused, and that so much of the mark-to-market hit that has been taken will swing back for the major banks and investment banks. So if fair value is the word, do you really want to market to 10 cents when there is really just such a large technical breakage in this market? Judge?
Go ahead, question from the audience.
So, having come from a background of somebody who uses mathematics and parameters in models for 20 years, I find myself in a situation now where if you use try the same game, then you're forced either to use parameters which are parameters of fire sale prices or prices which have been driven down by irrational or panic or collective behavior through deleveraging and so forth, that give you the real market prices. Those are the prices that sell in a FASB 157 environment. That, as we just mentioned, that is the market. So if you want to use other parameters which are not market parameters, then you find yourself in a situation where you're saying, well, there's no demand now, but within a certain time period, and I don't know what that time period is, then perhaps the demand will come back and the prices will be where they quote-unquote should be. So in that sense, in that time scale, the model will be quote-unquote right, and the market right now is wrong. It's wrong. Why is it wrong? Well, because people are simply acting irrationally, and the rules that the academics give us is that people have to act rationally in order for us to have models in the first place. So it's a very difficult situation that we find ourselves in, and I don't know how to solve it other than to try to state very clearly, when you have a model, what are the parameters that you're using? What are the assumptions that you're making, specifically right up front? Then at least you can describe what it is that you're talking about in some quasi-rational fashion.
I think that's what Douglas was talking about in the process, right?
Right, exactly. That's exactly right. I mean, I think it's the only way to try to make any sense of this. We all know we all don't know what the answer is, and then what we do know is we know how we came to a reasoned, hopefully reasoned solution, and that's what then you need to be transparent about. That's exactly right.
Doesn't all of this have implications not only for investors but also for regulatory capital? And how else, on that note, what are some of the other flaws, and if you all agree that indeed there are flaws in how we've thought about regulatory capital in the past?
I mentioned before, I think it's pretty clear that if you're using a VAR-based treatment for a level 3 type asset, or even some of these level 2 transition into level 3, that the assumptions embedded in your VAR model and the regulatory capital calculation for trading books built upon that certainly hasn't played out in this current situation. So I think that there probably should be some minimum, are you bigger long versus short, and the larger the two side, some sort of minimum percentage of notional values. And I'll throw out notional also remind me, keep in mind as well when everybody's talking about these level 2 and level 3 assets, for the derivatives, correct me if I'm wrong, Doug, they're talking about the mark to market of the contract. That's all that's hitting these asset values. So the notionals are a hell of a lot larger. It's just, the contract's worth minus 800,000 or whatever. It could be $1 billion contract. But I think there need to be some challenges in the reg cap.
Yeah, I agree. I think that one of the things that we've all discovered is that some of the regulatory capital regimes, and there are a number of them out there, you look at it and you say, it's really missing some of those key components, and whether it's liquidity, whether depending on how you think about credit risk, some of these key measures just are not really being well measured right now, and I think many regulators are going back and sort of saying, well, gee, have we gone too far out here, and do we need to modify our thinking? And I wouldn't be surprised if there are some revisions based on what we've seen.
Go ahead.
I guess I don't see the logic that the model price, if the model price is a predictive price, say this is what my model says, that when we come back to rationality, things will be worked. It seems to me that the spread between the liquidation price today and what the price will be when we come back to rationality, that's the return. That should not be built into today's price. It doesn't make sense to build it into today's price. I want to know, today's price is what it's worth today, not what I think people will pay for it when they become rational again.
I was the one who proposed this to tell all three, is because most of the people we work with, there's debates going on inside the firm, that there are lots of different people who have positions about what the asset is worth. We tend to talk about it as kind of market implied. So then there's the fire sale, the distress sale price. There's the market implied price that I think is the one that you're talking about, is given current market conditions, if you had that willing buyer, willing seller, that basically talks about what would we have as a price. But to be able to articulate what is, as an investor, I'm also interested in knowing what it is, why, what do you believe, what do you, the firm, believe it? I'm not proposing that's a number that Leon was asking about, what goes to the, I don't propose that 70 being the number that goes to the current financial statements, but it is a number that's important for the firm to know how it compares to the other ones, to get them. I guess the thing I'm most interested in is to get them in the same framework, where the same framework will deliver both of the numbers. What kind of changes do you have to change in the parameters to get it to move from 10 to 40 to 70?
Yeah, but that's the question. Is the return 10 to 70 or is the return 30 to 70? And it seems to me the return is 10 to 70.
Part of it, you probably, if you say, I'm a $10 bid for $5 billion, you may not get an offering. I mean, we're in stressful times, you may. But the likelihood, dealer bid offer spreads are pretty wide. Now, whether that offering for $5 billion is as high as 30, or whether that's 20, But that's part of the equation as well, thinking about the offer side.
But doesn't that lead to a question, though, if some firms are saying 10 and 10 goes to 70, and maybe we can characterize these levels as I fear, I hope, I dream. But what does that mean then for the comparability of financial statements? And would you argue that financial statements between firms aren't even comparable today?
No, I want to modify your phrases just a bit. I'll take
Go right ahead.
and I'll take I dream. I'm happy with those, but hope what I think we're trying to do is to get I think in there rather than I hope. Yeah. So, but yeah, I think that's what we're all struggling toward is can we begin to have some kind of process that's an acceptable process, or if there are acceptable processes. Can we have some kind of agreement of what things are reasonable things to look to be the hook data set that you go to, and what kind of challenges should you as the auditor or the regulator bring to challenge the values that are being proposed, whether it's to go to the financial statements or whether it's to deal with solvency issues.
Doug, knowing what you know, would you argue that one firm's financial statements are comparable to another?
For sure, I'm certain they're comparable. Now, easily compare. The comparison's not easy. I mean, clearly in these markets, there are ranges of reasonable prices, and so the answer is I'm certain that they're all comparable in one sense. But no, to answer the question more directly, of course it's a challenge, and I think that's actually one of the biggest challenges out there. When I look at financial statements across a given industry, you look at the numbers, and you really do find it hard to imagine that all of these numbers are the same. But there can be good reasons, and hopefully they're only good reasons, but it gets to things, Charles, you're talking about, it's going to be, what data do you have sometimes is going to be the biggest driver. When I look across various companies, some companies actually have some flow in some product. Some companies don't. Okay, well, if I have flow, I should actually have a better idea of what the value is. I might not. I might actually be completely beholden to a model because I haven't seen the deal, and I can't get a dealer to give me a price one way or another. So it makes it difficult, and that's why it won't be comparable. I mean, it's not going to be one for one. You can have the same contract, and two different people will have different data and will have different answers.
Leslie? I'm not sure everyone in the back could hear Leslie's question, so I'm going to go ahead and repeat that. It was, how would you think about a AAA bond that's backed by a monoline? And if without the insurance, you would have $1 billion loss. If you have the insurance, how would you value it? And I'll turn that over to the panelists. Why don't we start with Charles?
I'm good. Did a couple of these last week, I guess.
So let's kind of tighten it just a little bit. So the monoline is going to do a CDS on that tranche, that super senior tranche of that triple. Now, notice I already started in that direction. Did you want to go with one of these, or do you want to go to their traditional business? Is it their traditional business of the munis?
No, I was thinking in particular about the CDOs, just as an example
Yeah.
of how one overlays the guarantor.
I mean, there's the problem that I agree with you in general about my own credit worthiness factoring into the valuation process. But there's the place where whoever is writing the protection, their credit worthiness has to factor into the price. And so, yes, I do, I think probably it's more interesting to look at the monolines in that kind of it's gotten mechanical in thinking about these CDS on super senior tranches of CDOs of ABS, because now it's a technical, mechanical. We know we have to factor in the monoline's credit risk on it. I think the
But
one.
different people are doing it in very different ways.
Yeah, that's the
Brad could probably model a few up, throw in the F to default kind of models, and then you guys could whip up a correlation between CDOs and monolines, which might be on the high side. So gravitates towards the worst of anyway.
That kind of we're getting into that where on Monday, Wednesday, and Friday, I'm really opposed to FASB saying we got to start moving toward my own credit worthiness factoring into my financial statements. But on Tuesdays and Thursdays, I think about these kind of things where I have to, and that's where I finally end up with that piece that both of you mentioned about the funny part of it is if my credit worthiness goes down, I record a positive in my income statement. So I've kind of wandered around the question. We do see it being done. As long as you're as long as you're fairly careful in making sure you've accounted for that extra credit risk piece, you can get some kind of price. But I will accept the fact that different people are getting different prices.
I mean, it's an unfortunate byproduct of double entry bookkeeping that creates the real pain here. I think if you think about it in terms of the gain, it's very counterintuitive. I think if you look at the balance sheet, though, and you think about it in terms of the balance sheet and the value that that company is providing you, if you have a monoline that is trading at whatever 1,000 over, 2,000 or 1,500 over, the value of that liability, or the value of that asset, is really de minimis. So it actually is getting the world in better symmetry. It just has a bad outcome because you have to put that diminution of value on the liability somewhere, and so it turns out to be a gain. So I'm not going to, we're talking about financial engineering here as opposed to bookkeeping, and I'm not the right guy in my firm at least to talk about bookkeeping.
Bob, what do you think the value of such a security would be?
Well, there are a decent number that you can see some trades on wrap paper. Is it actually wrapped and deliverable, or is it some maybe hedge where there's questions about how well it's hedging, vanilla CDS versus some ABS, etc. But you tend to start with the value of the unwrapped position at appropriate spreads, and then with these spreads for the monolines, it's not too much, if any, additional value. And the other, related to that, the other problem that has occurred a lot is a lot of these structures have been done with the asset-backed risk in derivative form, and there are a lot of host bonds. So you've got a lot of MBIA, GICs, etc., where you really have a major part of the SPV valuation is a direct liability from the monoline, and those have been challenging.
What do you think? One question we've been dancing around a little bit, I think, is the role of the rating agencies in this, and whether we need to rethink how the rating agencies are used, both in calculating regulatory structure and in valuation. And I'll turn it over to, let's see, maybe we can start with...
Not me this time.
We'll start with Bob.
Okay. Well, clearly the rating agencies screwed up massively in their underwriting of subprime, number one, and even more massively in the underwriting of CDO squares, and particularly mezzanine CDOs and some of these thin tranches. So they really blew it. The SEC obviously is focusing a lot more on them. I think one of the things that I picture them in a regular way being brought to task on in the future is almost like they come down to some hearing and they have a list of, these are the things you rate X, a normal spread for that rating is, Y basis points, but here is this, this, and this, and it's materially different from kind of the normal type spread for that. And to get a process that sheds some light on that and puts some pressure, I think would be constructive, because when we step back and look at it, there wasn't a whole lot of surprise. It was pretty, it's clear a lot of things were trading quite a bit different than their rating would imply. And there's a lot of gaming of the ratings, and the numbers are right there to see where the big differences were.
Anybody else with anything to add on that point?
Yeah.
Go ahead, sir.
Yeah, as someone who just started working for a rating agency, any suggestions for how we can improve the process are welcome.
Any
suggestions on how to improve the process of the rating agencies?
Well, I think obviously they're starting with a much more conservative assumption on home price appreciation, defaults, etc. I think that, I think the suggestion I made goes in the right direction. I think there are the rating agencies, for as much focus as around, let's regulate them, let's do this or that, no one has more incentive than the rating agencies to restore the credibility. So, it's going to need to go in that direction. I think there also remain challenges vis-a-vis the probability of default trade-off versus recovery upon default. I think a lot of the financial engineering that went around was arbitraging that relationship. You saw a lot of really skinny tranches, so maybe it had a X-rate, single A probability, but if you got there, it was wiped out. So it didn't look like a traditional single A corporate. So I think there needs to be a better job of that trade-off between recovery and probability.
Peter, do you have anything to add?
The one thing that's the obvious piece is when I look at some of the older models that had a very strong flavor of expected loss models, I guess I'm expecting that they'll have more of a flavor of tail loss models. I mean, that's the thing for somebody who came into this movie late, that the products had all evolved before you talked me into doing it. That I was so shocked just to see how sensitive little changes in the tail of the distribution, because of what you said, that there's so many tranches out there that are so thin that once they're pierced, they're not just pierced, they get pierced and they're gone instantly. So the thing that I guess I expect to see in the new version of models is a lot more sensitivity to tail-based measures.
Question right here.
Isn't there a basic conflict of interest here that the rating agencies are paid by the institutions they're giving the ratings to, and isn't that a fundamental problem that needs to be addressed?
That's above my pay grade.
I think that one's overrated.
You do. Why?
I think if you're a shareholder of a rating agency, that incentive, I don't know, I just don't see a major conflict. I think that there was pressure to do the next deal and pressure between rating agencies and a lot of smart people pushing of, this isn't going to happen, and all these, the models were being gamed. But I don't think who paid them was a major driver of how it played out.
You don't think if a client didn't get the rating he wanted from S&P, he wouldn't go down the street to Fritz and say, if you give me the rating I want, you'll get a lot more of my business? You don't think that happens?
Sure.
And you don't see that?
That goes on in corporates. I don't think it's as large a cause for the problems that has been kind of focused on.
Well, let me make one comment. The rating agencies didn't cause the subprime crisis, but there's one organization that could have prevented it. It's the one place that was focused that could have put a stop to it, and they didn't.
They enabled it.
Yeah.
We've got a question back here.
Actually, a comment on the previous question and then a question. the alternative model for the rating agencies would be to be paid by the investors. And if you really think about it, it will create even more problems because the big institutional investors could be interested in pressing the rating agencies to modify ratings according to their needs. So within rating agencies, there is a discussion now, and I think the view is that there will be no less conflicts in that particular model. The question I had was, there was a historic relationship between the investment grade spreads in the credit markets and equity markets. And the Bank of America puts out this graph which shows that this relationship recently has completely broken down, that the credit spreads are about the equity market of 850 for S&P. So if you had any comments about what's going on and why that is happening.
When you back out the risk premiums out of some of the credit spreads we're seeing fixed income paper trading with risk premiums that are comparable to the risk premium you'd see on a pharmaceutical IPO. So I mean, to me, that's what that we've got those two big premiums in the credit market. We've got risk premium, to my view, a remarkable risk premium, and then the liquidity premium on top of it that's breaking that historic relation.
Question from the front row.
So one of the things that I think we've been stressing is that we believe that the current market is in some sense irrational and unphysical, and it's going to at some point come back. Somebody's going to jump in the pool to start buying, and then others will jump back in, because you can't have 26-year-old traders that simply make 1% on their money by putting it in some money market fund. They won't do that. So the market at some point will come back. But at the same time, I think in the future that modelers have a lesson. And the lesson is something along the lines that Charles mentioned, which is that there is no unique market price because there are variables over which we have no control that have some probability distribution that we should somehow put in as some kind of a model error in the quote of a model for some security. And I think that going forward, that the determination of some reasonable way to calculate some kind of model error should be part and parcel of quantitative valuation of securities. That's one thing. Second thing is that for VaR, it's the same kind of thing. If you base your VaR on what's happened in the last year or 2 years and actually nothing has happened, you don't have a very big risk, do you? But that's really not very interesting, because the only interesting thing that happens is when everything falls apart. So for a long time, I have been a big fan of having a stressed VaR, where you put in fat tail vols, stress correlations, a liquidity premium, time scales, all kinds of things to see what would happen to your risk if you were really in some kind of a meltdown situation. And I think that kind of construct, which would give some kind of an error on the VaR itself, is also going to be in the future something that should be a useful construct.
It leads to an interesting question, which is what would the ramifications of thinking of VaR differently, calculating VaR differently, and also trying to build non-quantitative variables like uncertainty and fear into what's supposed to be a quantitative number? What does that mean for risk management at firms?
Well, certainly there are numerous problems with VaR, and I think that it's difficult to draw any conclusion other than the fact that the VaR quantitative approaches to risk management bear a lot of blame for the losses that have occurred. I think you had a lot of firms that were cranking out origination profits on doing deals, holding a lot of AAA and AA rated securities because your VaR model says, it can only move 2.2 basis points to a 99% probability, and heck, the duration's 4, so there's no risk to those securities, and obviously it turned out to be quite a bit different. I think the suggestion we heard is a good kind of approach, and whether you do that within the context of VaR or do a standalone stress, the more you do that, it kind of becomes a stress. And also, there are some advantages of even going to a little bit simpler methodology where you are taking, we did some work where we based it off of our notionals, and we took haircuts of the notional, sort of a leverage capital-based model, and we only gave partial credit to some of the hedges, depending on the nature of the relationship. So there's different ways to kind of skin the cat of getting in the same direction.
The answer I do is do a commercial for a moment about 3 documents that have appeared recently. That if you haven't looked at them, the senior supervisor's report on the market events is excellent. The IIF has a report that's the same kind of title. And then the most remarkable document I've seen in a long time is UBS's report to its shareholders. Just if you haven't read that one, you should go and read it, So, I mean, there's one where in all of those they talk about the importance of doing the stressed bars that you were recommending, about the importance of seeing how bad the uncertainty is. The problem always is that we're always going to have a stress test, and how much stress is enough. I've never found somebody who can tell me the answer to that one. But the kind of piece that's kind of the hidden risk that comes particularly out of that marvelous UBS report is thinking that you can hedge something as complicated as these things are and set them aside and say, well, now once hedged, they're ever safe, and I don't have to ever look at them again, and they don't even appear in the VAR framework again. So, I mean, we've had another instance where we've learned a lot of ways to lose money. Some of them are old ways that we forgot, and some of them are new variants. But if you haven't read those 3, I'd recommend it.
I think we have time for one more question from the audience. I see one more back here.
Doug, there are pretty tight constraints on your ability to disclose as a public company more than one number.
Yes.
The easy, I think, relevant example is Primus, which discloses both GAAP accounts and their interpretation of economic value. Took them a lot of work with the SEC to really show the numbers. So how realistic do you think it is that you'll be able to show more than one number in public accounts?
There are definitely challenges to showing a range of numbers. That being said, I think the SEC is waking up and understanding that this is unusual times, and accuracy is something which is, or the perception of accuracy in a single number may be a little bit misplaced. And so I think that there is definitely a movement to additional disclosure, encourage disclosures, and trying to give more information about the natures of your risk and how you think about your risk and sensitivity. But you're right, at the end of the day, you got to book to a number, and the number your U.S. GAAP filer is U.S. GAAP number, as defined by whatever standard it is that you're measuring, so 157 in this case.
Anybody else? I've been told we have time for one more question. I think that may be it. Well, thank you all very much for coming.
The most